In previous lecture, you learned about the concept of financial derivatives, different type of derivative instruments, and an example of call options. Financial derivatives are a special type of instruments that a company invests in for different reasons, and it also differs from regular financial instruments such as stocks and bonds. So one major criteria of derivatives are that the values are driven by one or more underlying assets such as other stocks, bonds, or commodities, and it also have an identified payment provision. So when a company wants to invest in derivative instrument, the company may not need to invest initially a huge amount of money. Rather, the initial investment amount is very little. Also, for the derivative instrument, it requires or needs some net settlements. Now, this chart will show you the differences between the traditional financial instrument versus the derivative financial instrument. For traditional financial instrument such as trading securities, a company can purchase other companies' stocks and can hold it temporarily and can sell it. That means they are investing directly in other companies' stocks or financial instrument. On the other hand, a company can purchase derivatives related to those stocks. That means instead of purchasing those stocks, the company can purchase the right to purchase the stocks, such as call options. So if you think of the payment provisions for traditional financial instrument, if you want to purchase the stocks, so what you have to pay, you have to pay the stock price for each share multiplied by the number of the shares. On the other hand, for derivatives, and you also learned the example of call options, the payment depends on the changes in the stock price, and then we multiplied by the notional amount. That means how many shares are related to that contract. Initial investment for purchasing traditional financial instrument, you need a huge amount of money at the beginning, because to buy those stocks the investor needs to pay the full amount. On the other hand, for derivatives, the initial instrument cost or the initial investment cost is really low. Settlement. For traditional financial instrument, you pay cash and the stocks are delivered. This is how you settled with this purchase. On the other hand, for derivatives, so you don't need to physically purchase and sell stocks or exchange it. Rather, based on the changes in the stock price, you actually settle and you receive the equivalent amount of cash. So far we learned the derivatives. Now we will see hedging. The concept of hedging is to offset the negative impact of the changes in the price or the value or some other items. So in one hand, derivatives are used to make some gains, changes in the stock price or changes in the other items or bonds or commodities. On the other hand, hedging is used to offset the negative impact of the changes in those price or cash flows. So FASB allows that there might be two types of hedging you could do. One is the changes related to the fair values, another is changes related to the cash flow. So we call it fair value hedge and cash flow hedge. So what is the fair value hedge? So the fair value hedge is that the hedging that you use to offset any negative impact related to the changes in the fair values, and you also need to record those as an asset or liabilities based on your exposure. And in a perfect hedge position, the gain or loss that you make depending on the changes in the fair values should be equal to the loss that or gain you are making based on that hedged assets or liabilities. So we will see one example, and this is fair value hedge example. December 31st, Hayward Tires this Hayward company actually manufactures tractor tires, and they are holding some inventories. 1,000 tires. Each tire cost is $200. Now, Hayward is piling up these inventories, and their expectation is that in upcoming planting season there will be high demand in tractor tires, so they want to hold those inventories. So initially they record the inventory value 1,000 tires, $200, so they will record current asset inventory 200,000, the value of those tire inventory they are holding. Now if the tire price goes up, of course Hayward will make a gain. But what if tire price goes down? Then Hayward need to face some losses. So what Hayward wants to do, Hayward wants to protect the loss that may result in terms of declining the tire inventory, because this inventory is also used as a collateral for some bank loans, so they really would like not to lose any value of those inventory. So now here we'll see how Hayward can hedge any instrument here, and then Hayward can protect the loss related to any decline in the tire price. To hedge this risk, Hayward locks in the value of his tire. And on January 2nd, how did they do that? They purchased a put option to sell rubber at a fixed price. So rubber is one of the raw materials to make the tire, and tire price may also depend on the rubber price. If rubber price is high, tire price may go up. If rubber price is going down, tire price may go down. So it's good to use rubber for using as hedging purposes. And they purchased put option. You are familiar with call option. Call option means a right to purchase. On the other hand, put option means a right to sell. So Hayward Corporation entered into a put option to sell rubber at a fixed price. So they will be able to sell rubber with a fixed price, and this fixed price is they will sell 4,000 pounds of rubber at price $50 per pound. And currently the spot price for the rubber is the same $50. So apparently there is no intrinsic value, and just to make this example simple, they didn't put any other values related to that put options. So now here, March 31st, the company is preparing their quarterly financial statements, and they found the fair value of the inventory declined by 10%. So related to those tires that they are holding, the value went down by 10%. So they have inventory value loss. They have to write down the inventory value loss. So what they will do, they will debit unrealized holding gain or loss. They will show this loss as unrealized holding gain or loss related items, and they will debit it. Since the total amount of inventory they are holding is 200,000 and it declined 10%, which means 20,000, and they will credit this special account allowance to reduce the inventory to fair values. Now note that this entry is unusual, right? If we do not have any put option which is used to protect the value decline loss related to the inventory, we would not have to do that. Usually for the rule of LCM, lower of cost or market price, we write off the inventory value, but we are not doing it. Rather, we are showing this as an allowance to reduce the inventory value, and we are debiting this loss because we have a put option to offset this loss. And we found that rubber price also declined by 10%. Now remember, based on the put option, the company has a right to sell rubber at $50. That was the previous market price too. Now rubber price declined by 10%. That means for per pound, the rubber price is now, if you take off 10% of $50, now it's $45. So now here the company from outside can purchase rubber for $45 and sell it to the company from whom they purchased the put option for $50, and they can make $5 gain. So since the rubber price declined and company has a right to sell the rubber at a higher price, that means the company is making a gain from that put option. So we will record the put option related gain or loss. Put option price for each pound rubber price declined by $5 since the company has a right to sell the rubber at a higher price. So for each pound the company is making unrealized holding gain or loss $5 multiplied by the notional amount, because the put option contract was for 4,000 pound of rubber. So if you multiplied $5 by 4,000, the company is making a gain, and at the same time the put option value increased by 20,000. So now how the company will show that on their financial statement? Assume that this quarter end financial statement inventory value reduced because of the decline, and they netted it as the allowance to reduce inventory to fair value, and that reduced by $20,000. Current inventory value is 180, and on the other hand put option value they showed as an asset under the current asset part 20,000. So altogether there is no change on their current asset part. The same thing you will see in their income statement. Because of the inventory value loss, they have a loss $20,000, but on the other hand from that put option they are making a gain. So this is how the inventory value loss is hedged or cancelled out from the gain that they are making from the put option. This is how companies use fair value hedge to protect the negative impact of any item that they may face any loss because of the decline in the fair value, and this is called fair value hedge.